Hello, everyone. Welcome back to the podcast. Today, we're going to be discussing topics in central banking, monetary and macroeconomic policy. Particularly, today we're going to be doing changes in the Federal Reserve policy that took place as a response to the COVID pandemic and sort of the aftermath there. So, in recent decades, we've seen dramatic changes in the way that the central bank operates in times of crises. Traditional wisdoms, a long-standing education in monetary policy requires some significant updates. Now, in another episode, we're going to cover the changes in the Federal Reserve policy that took place during the great financial crises, another super important episode that you'd want to look at. This episode is going to focus on those changes in Fed policy that took place in response to the COVID pandemic. So what are we going to cover here? We're going to cover about 6 things. One of them is going to be a dramatic quantitative expansion in the Fed's balance sheet. A second thing we're going to talk about is the dramatic expansion in the kind of qualitative composition of what was on the Fed's balance sheet. Number 3, we're going to talk about the abandonment of reserve requirements for banks. Number 4, a redefinition of the money supply, particularly the redefinition of M1. Number 5, we're going to be talking about the Fed's pivot or switch or mandate creep from average inflation targeting to a longer term sort of average of inflation targeting. And number 6, we're going to talk about switching the mandate from a focus on employment to a focus on what's called broad-based and inclusive employment as a target and discuss what the ramifications there might have been. So first, why is the balance sheet important? Why are we going to pay attention to changes in its quantity as well as its composition? Well, the Fed's balance sheet is its balance of assets and liabilities, and this becomes one of the primary tools for the conduct of monetary policy. Whether it is influencing interest rates at the long or short end of the curve, managing the money supply, or supporting financial market stability, the balance sheet might be an important tool to use. Now, it's worth keeping in mind that we've seen decades of rock bottom interest rates, and so this alternative approach to policy via the balance sheet might have been an absolutely essential tool, considering that at zero interest rates, the Fed had probably reached its zero bound because, well, nominal rates, they can't fall below 0%, so it's tough to stimulate the economy once you've hit that lower zero bound of nominal interest rates. So let's look a little bit at the Fed's balance sheet in terms of size. The Fed's funds rate gets a lot of attention in the press. This is what you see voted on periodically at FOMC meetings and one of the things that everyone pays attention to. But the Fed can use its balance sheet to affect longer-term interest rates far beyond the federal funds rate. For an economic stimulus, the Fed might practice what we call quantitative easing, which expands the balance sheet in terms of the number of assets that it has, or it might pursue some sort of quantitative tightening, which would be contracting the balance sheet. Quantitative easing, the Fed's going to go ahead and buy securities of one kind or another, replacing them with fresh money on the balance sheets of institutions in the economy. They might buy treasuries, mortgage-backed securities, and now even corporate debt. This is going to inject money, lower interest rates in these asset markets, and stabilize the price of these securities, providing essentially a backstop, a ready buyer of an institution for anybody that might be offloading these forms of debt. And in that sort of sense, it allows a different window of opportunity for the Fed to step in as sort of lender of last resort to stabilize financial markets in general, or to make sure liquidity is flowing in those markets at asset prices that the Fed deems to be tolerable or acceptable. Now, on the one hand, there might be some benefits of this in terms of transparency and market signaling, and this is because we can look at changes in the balance sheet and the composition of changes in the balance sheet and kind of see where the Fed is intervening in the economy and what sort of interest rates they are trying to impact, if you will. Now, this balance sheet allows us to see sort of a footprint of the Fed on markets as it tries to pursue its historical dual mandate of trying to manage low inflation and generate full employment. So what you see here in this graph are the total assets held by the Fed. This is just the asset side of the balance sheet. And if you remember, buying up and accumulating assets means that you're spreading cash throughout the system. Now, what you can see is this quantitative easing really started in response to the great financial crisis, the GFC, in 2008, 2009. And that was a massive spike in quantitative easing. Now, that quantitative easing continued periodically throughout the interim period up until the point where the pandemic started. Now, there's a slight dip in the balance sheet as the Fed tries to normalize things, and then an absolute explosion in the asset side of the balance sheet. That boom in quantitative easing absolutely dwarfing the already historically unprecedented boom in quantitative easing that took place during the great financial crisis. In this figure that you've been looking at, this is indicating that the explosion in Fed assets purchased since March of 2020 dwarfs even the 3 rounds of quantitative easing that came before it. The Fed increased its assets from $4.2 trillion to $7.6 trillion, and this is an incredible one-year jump of $3.3 trillion, an increase of 78%. This trajectory, well, it continued upward as long as the data set is showing. Now, what else is interesting about the balance sheet? The second thing that's interesting about the balance sheet is changes in the composition of the balance sheet. So changes in what assets the Fed is particularly buying. Now, before the great financial crisis, the balance sheet was small and it was very, very narrow. Not a lot of variety of assets on there. It was focused primarily on targeting the federal funds rate through open market operations. But confronted with the potential large-scale collapse of the financial system in 2027, the policy of quantitative easing was put in place. The Fed began purchasing massive quantities of longer-term U.S. Treasuries and also distressed mortgage-backed securities. By 2014, reserves had grown from $40 billion to $2.8 trillion, reserves awash in the banking system that are available for the creation of loans and the creation of money. A whopping increase, effectively, in liquidity in the system. Now, there was a brief retrenchment from 2017 to 2019, which we saw in an attempt to try to normalize this balance sheet. And during the COVID pandemic, the explosion began again, with one key difference. The Fed now expanded the types of assets it was allowed to purchase. While these lending facilities were special emergency programs, and many of them have since been terminated, they are essential for understanding monetary policy during the pandemic and, in all likelihood, will be resurrected again during the next crisis whenever it materializes. What are some of the interesting things about the change in the composition of this balance sheet? Well, the Fed established 2 new facilities to support the flow of credit to U.S. corporations, and this occurred on March 23, 2020. Number 1, the Primary Market Corporate Credit Facility, PMCCF. This allowed the Fed to lend directly to corporations by buying new bonds issued and by providing loans. This is quite strange, injecting money straight into the private sector. Number 2, the Secondary Market Corporate Credit Facility. In this credit facility, the Fed could purchase existing corporate bonds as well as exchange-traded funds investing in investment-grade corporate bonds, thereby stabilizing the corporate bond market and ETFs that were participating in exchanges in that market. These facilities allowed companies to access credit so that they are better able to maintain normal business operations and normal capacity during the period of dislocations that are related to the pandemic, essentially suspending normal market operations and normal market responsibility. Given these interventions, one might ask whether or not market prices in corporate debt bears any meaningful reflection to the underlying creditworthiness of these firms. And during the crisis, the answer would most likely be no, that there was no price reveal, no meaningful connection between prices on corporate debt and underlying risk. Additional lending facilities include the Paycheck Protection Program, and this was April 9th, 2020. This was to supply liquidity to financial institutions that were participating in the Paycheck Protection Program. At peak usage, this facility was about $90.63 billion. Another facility, the Municipal Liquidity Facility. This is April 9th, 2020 as well, and this allowed the Fed to lend directly to state and local governments. This role had previously been the responsibility of Congress, and now it again is. Peak usage of this facility was $6.3 billion and has since been terminated. Also, the Main Street Lending Program, April 9th, 2020, lending to small and medium-sized businesses as well as nonprofits. At peak, this utilization was $16.5 billion. Now, at this point, the Fed has the capacity of influencing credit markets, not just for commercial banks, but for commercial and residential real estate, corporate bonds, commercial paper, cars, student loans, even personal credit cards. Next up, the abolition of reserve requirements. If you read through a textbook, you'll go through a long section in Money and Banking about how changing the reserve requirement will impact the multiplier and thereby impact the money supply. Lower reserve requirements allow for more lending and more growth of the money supply, all other things held equal. Higher reserve requirements, a contraction of the money supply and a contraction of bank lending, all other things held equal. During the pandemic, the Fed had completely abolished the reserve requirement. So in 2019, the Fed announced a switch from the system of scarce reserves to one of quote-unquote ample reserves. And in March 2020, the Fed reduced the required reserve ratio, the required amount of deposits held as reserves in the vault, say, to 0.0%. Now, the argument was that this was going to free up funds to be lent to businesses and households, and the attempt would be, of course, to increase the money supply through increasing the money multiplier. But the short-term effect of eliminating reserve requirements was, in fact, insignificant. This is because the Fed began paying interest on reserves in 2008 as a way of injecting liquidity into the banking system. So banks were holding tremendous amounts of excess reserves, and so they weren't really constrained in any meaningful way by reserve requirements to begin with, and getting rid of them wouldn't have changed their behavior very much. The more important tool would have, of course, been changing the interest payments on required reserves paid by the Fed to the banks. And so the level of required reserves quadrupled after the GFC from $40 billion to $200 billion, and then dropped dramatically to zero. And that's what this graph is indicating here. One question is, if reserve requirements were non-binding on bank lending before the change, then why would the change stimulate more credit provision as a COVID stimulus? The answer is a bit ambiguous there, but what a dramatic graph. You just don't see time series like this very much in economics unless something's going really haywire, which of course it did during the pandemic. There's our change in required reserves dropping to zero. Oftentimes, changes like this in a data set have a lot to do with a discrete change somewhere else. Number 4, redefinition of M1. M1 and M2 are traditional measures of the money stock. And M1 is oftentimes referred to as narrow money, being the most liquid assets that can readily function as money in its role as a medium of exchange. M2 consists of everything in M1 plus less liquid assets, things like savings accounts and money market mutual funds, and measures of money go broader and broader, M3, M4, so on and so forth. So savings deposits were considered less liquid, and so they were included in M2, but not included in M1. But in April 2020, the Fed decided to eliminate what's called Regulation D. Regulation D limited the number of withdrawals from savings accounts to 6 per month. With this regulation eliminated, you could move money between checking and savings without any limitation or any friction. And so this basically annihilated any distinction between a checking account, which is already included in M1, and savings account. The result, of course, is just taking a portion of M2 and shifting it into M1. That portion was savings accounts that had previously been under the auspices of Regulation D. And the result in these statistics is, of course, a massive and discrete jump in M1, which we see here. Now, on the one hand, we can view this reclassification as an appropriate move for custodial management of the data set. On the other hand, it occurs at a rather auspicious time, the outset of a historically unprecedented monetary stimulus in response to a once-in-a-100-year global pandemic. And this reclassification clearly is going to obscure any massive increase in traditionally measured M1 that might, and in fact did, occur. So this makes it difficult for the casual observer to connect a rise in M1 with subsequent inflation, which is kind of okay because M2 might be a stronger predictor of inflation down the road anyway. Yeah. This is made a little bit more difficult, the idea that you might be able to distinguish between changes in M1 and M2, because when they did the switchover, they included all of the savings deposits into a category called quote-unquote other checkable deposits that already included a bunch of quote-unquote other checkable deposits from the previous M1. So it just kind of got mixed in, and it's very, very difficult to trace out. We can't just subtract out the savings deposits from M1 because we don't exactly know what the magnitude is. But if we look at M2, we can note that it includes historical M1 and the new M1. And so if we're looking for a big spike in the money supply as a response to the Fed COVID program, we're more likely to see meaningful data there in M2, which of course we see here. Now, some critics feel that it may have obscured a large increase in the U.S. Treasury holdings and foreign bank deposits with the Fed. As such, this data switcheroo might have been used to conceal that the Fed was monetizing government budget deficits, something that Kevin Warsh has said was essentially the case in recent interviews. The Treasury would sell bonds on Monday, and we would buy them on Thursday, is a nice quote from the Fed nominee in 2026. Number 5, switching to average inflation targeting. The Fed has always had a dual mandate to balance and have a balanced priority between two goals. One of them, full employment, quote unquote, and 2, price stability. Now, the interesting thing is, how do we define full employment and how do we define price stability if those are the targets that we're wanting to reach? Well, since 2012, the official target for price stability was 2% annual percentage increase in the price index for personal consumption expenditure. This is a constant target that resets every year. We want it to be 2% every year. But in August of 2020, the Fed changed this policy statement to the following, quote unquote, the committee seeks to achieve inflation that averages 2% over time. So if there are periods when inflation is below 2%, the Fed feels perfectly comfortable achieving an inflation target that is above 2% for possibly quite some time. One can imagine that this gives the Fed far more latitude to miss its old 2% target for some time without having to admit failure or poor stewardship of the economy. It can be off the mark for some time without giving inflation expectations a quick signal to become unanchored. And because in the past, the inflation rate of 1% might have caused the Fed to try to reach 2%, under the new rule, the Fed might attempt to reach 2.5 or 2.75% for a year and a half, 2 years, just to average things out. Now, I'm ignoring the complication of exponential growth to keep the math simple, but hopefully you can see what I mean. A lot more volatility. So under the new rule, there's a lot more volatility in inflation and less accountability for the precision of inflation targeting. Higher inflation, it lowers the real cost of borrowing. It can make governments and corporate debt appear more sustainable. Might also be related to getting around the zero bound, right? If the Fed can't encourage more borrowing by making nominal interest rates cheaper than 0%, well, by allowing the economy to run a little bit hot with higher price expectations, the Fed can lower the real interest rate and support investment through that channel. A cynical interpretation of this 2020 policy change might be that the Fed knew that its pandemic response would likely generate inflation, and it wanted to give itself a framework to justify this failure within their own rule set. Number 6, broad and inclusive employment. In 2020, Jerome Powell led a policy framework shift, redefining maximum employment to be broad-based and inclusive employment. Now, maximum employment is never zero. It is the level of unemployment that can be sustained without putting upside pressure on inflation. A typical estimate of maximum employment, the type that's not consistent with generating rampant inflation, is 4.4% for the U.S. Now, theoretically, attempting to push unemployment below this rate would result in labor scarcity, which would drive wages up and then consequently drive up inflation. Broad-based and inclusive employment reduces the attention paid to this non-accelerating inflation rate of unemployment and puts the attention on other employment goals. Here's a statement by Jerome Powell in 2021 to give you a feeling what broad-based and inclusive employment means to the Fed chair. Quote, "We only need to look back to February of last year," he's talking pre-pandemic, so February 2020, to see how beneficial a strong labor market can be. The overall unemployment rate was 3.5%, the lowest level in half a century. The unemployment rate for African Americans had also reached historic lows. Prime age labor force participation was its highest in over a decade, and a high proportion of households they saw and perceived jobs to be, quote unquote, plentiful. Overall, wage growth was moderate, but wages were rising more rapidly for earners on the lower end of the scale, close quote. Now, no one can argue that these are not very desirable outcomes from a thriving labor market, nor that the reduction in disparities wouldn't make for a more desirable society. But the question remains as to whether or not it is the job of the Federal Reserve to attempt to achieve these ends. Critics might argue that in seeking to target a tighter labor market, that this delayed Jerome Powell's response to rising inflation coming out of the pandemic and slowed the appropriate policy response of raising interest rates until it was essentially too late. Now, it must be remembered that inflation hurts everybody in the economy and often hurts low-income earners hardest, as they might lack the competitive advantages useful in negotiating higher wages in a looser labor market or in response to inflation. So this has been the 6 big changes in monetary policy since the pandemic. I hope this topic has been enjoyable for you, made some of the nuances a little bit more clear, and helps you understand or give you more purchase on what's happening in monetary policy in the world around you. Thank you for your time and attention, and enjoy.